Your money-making broadcast starts now. Good evening, Canadian investors. Apple just smashed revenue guidance on booming iPhone and Mac demand, Eli Lilly blew past estimates with Zepbound sales skyrocketing, and big tech AI Capex is now seen topping $1 trillion by 2027. The Bank of England held at 3.75%, the ECB kept rates on hold as Eurozone inflation hits 3%, and Stellantis tumbled 10% on weak Q1. There's a jet fuel bidding war driving energy prices, and Nvidia just invested in an AI legal startup. I'm Chloe, and we're breaking it all down from a Canadian perspective. Here's your April 30th market recap from a Canadian lens. First, the Federal. 3 hawkish members voted against holding rates steady, the most dissenting FOMC votes since 1992. For Canada, this is critical because it directly impacts the Bank of Canada's policy room. If the Fed stays hawkish, the BOC has limited ability to cut rates without crashing the loonie. The Canadian dollar weakened today as the PCE inflation reading confirmed that U.S. rates are staying higher for longer. Powell's decision to stay on as a Fed governor after his chair term ends provides some stability. Kalshire bettors now see an 86% chance that Kevin Warsh is confirmed by May 15. For Canadian fixed-income investors, this means Canadian bonds could face continued pressure from the U.S. yield curve. Big tech delivered a divergent story. Alphabet surged 10% on strong cloud earnings, while Meta fell 8.6% after Beijing blocked its mainest deal. Microsoft slipped 3.9%. For Canadian investors holding U.S. tech via the TSX, Shopify, which trades as a tech proxy, needs to be watched closely. The broader takeaway, cloud spending is accelerating, which is good news for enterprise software names on both sides of the border. Apple smashed expectations after hours, with revenue guidance topping analyst estimates driven by booming iPhone and Mac demand. For Canadian investors, Apple's strength is a positive signal for TSX-listed suppliers and the broader tech sentiment on the TSX. AI Capex is the mega theme. Big tech capital expenditures are now seen topping $1 trillion by 2027. That's a staggering number that underpins demand for data centers, chips, and energy. Canadian investors should watch TSX-listed infrastructure and energy names that feed into this build-out. Inflation is the headline. The March PCE reading posted its biggest increase in almost 3 years. Driven by the Iran war pushing up oil prices and supply chains, this is directly relevant to Canada as a commodity-based economy. Higher oil prices are a benefit for Canadian energy producers like Suncor and Canadian Natural Resources, but they also feed into Canadian CPI data. Jamie Dimon's warning of a potential bond crisis resonates particularly for Canada, because our housing market is heavily tied to long-term bond yields. If global debt risks build, Canadian mortgage rates could stay elevated longer than expected. Caterpillar jumped 10% with a 38% surge in construction sales. This is directly relevant for Canadian mining and energy infrastructure. When CAT is selling more equipment, it means resource companies are investing in production capacity. Qualcomm surged 15% on AI edge computing opportunity. Ford profit jumped and raised its outlook. Royal Caribbean said cruise bookings recovered. All U.S. names, but they tell us about consumer health, which directly impacts Canadian exports. On the commodity front, the BWET tanker shipping ETF is up over 600% this year amid the Iran conflict. That's an extreme move that signals how disrupted global shipping routes have become. South Korean stocks just enjoyed their second-best month ever, driven by AI memory chip demand. Korea's market is now bigger than the UK's. This has indirect implications for Canada's technology and resource sectors. Eli Lilly blew past quarterly estimates and hiked its full-year outlook. Zepbound and Mounjaro sales skyrocketed, reinforcing the GLP-1 drug revolution. This has implications for Canadian healthcare and any TSX-listed pharma names. Stellantis fell 10% after disappointing Q1 results, dragged by weak European demand and inventory challenges. This contrasts with Ford's strength, and Canadian auto parts suppliers on the TSX should watch the divergence closely. There's a jet fuel bidding war brewing as airlines scramble to secure supply amid the Iran conflict disruptions. This is bullish for Canadian energy refiners and could amplify the oil price tailwind for TSX energy producers. Nvidia invested in an AI legal startup, signaling that AI's next frontier is professional services. For Canadian tech investors on the TSX, this underscores the broadening AI opportunity set beyond just hardware. The Bank of England held rates at 3.75%, while the ECB also kept rates on hold. Eurozone inflation sits at 3% with growth stalling, a stagflationary signal. For Canada, this means global central banks remain cautious, reinforcing the BOC's own dilemma. Now for stock picks with a Canadian perspective. First pick, Enbridge. As oil prices remain elevated due to the Iran conflict and global supply disruption, Enbridge's pipeline network becomes more valuable. The legendary growth stock investor, Philip Fisher, would use his scuttlebutt method here. He'd look at the long-term contracts, the regulated revenue model, and the management's capital allocation discipline. Fisher taught us that great companies have consistent R&D, and for Enbridge, that R&D is in energy transition infrastructure. He'd see this as a high-quality compounder trading at a reasonable price. Second pick, Royal Bank of Canada. Canada's largest bank offers a defensive yield in a high-rate environment. The world's most famous value investor, Benjamin Graham, would love the margin of safety here. RY trades at a reasonable PE with a strong dividend history stretching back decades. Graham's principle, buy when the market price is significantly below intrinsic value, applies. Canadian banks have pricing power and oligopolistic advantages that create a built-in margin of safety. Third pick, Ford. Up on a profit jump and raised outlook. The legendary fund manager, Peter Lynch, would love Ford as a cyclical turnaround play. He famously classified stocks into categories. Ford is a cyclical, and the key to cyclicals is timing. When auto inventories are lean and demand is resilient, that's when you buy. Lynch would also note the tariff refund, a competitive advantage that many overlook. Fourth pick, SoFi at $16.10, recovering from last week's sell-off. The modern contrarian investing legend, John Templeton, would look at this differently. He'd say buy when sentiment is worst. SoFi's CEO defended holding guidance steady due to macro uncertainty, not fundamental weakness. Templeton taught global investors to buy into pessimism. With 41% revenue growth and a beaten-down stock price, he'd see the classic contrarian setup. Tomorrow watch for Apple earnings reaction in after hours, Eli Lilly's read-through for Canadian pharma, TSX energy names on the jet fuel bidding war, and Stellantis weakness spreading to Canadian auto parts suppliers. I'm Chloe, see you tomorrow for another TSX and Wall Street recap. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.